Have you ever heard someone say something like this? I spent hundreds of hours studying blockchain and cryptocurrency, taught myself how to use the technologies, tried to make wise investments, and my mom buys Shiba Inu because I like dogs, her exact quote, and outperforms my portfolio. This is a super common sentiment, and it's one of my favorite examples expressing it. And the question that I'm going to address in this video is, why didn't this person's supposedly smart approach and all of their due diligence pay off for them? Why didn't it work out? And more generally, does SHIB's success and the success of other meme coins and other projects that lack much fundamental value, does that mean that a crypto project's fundamentals are irrelevant? Basically, in this video, I'm going to explain what this person doesn't understand, what they're getting wrong, and how you can avoid falling into the same confusion that they're dealing with. So welcome back to Upside Down Data. If you like taking a rigorous, quantitative, scientific approach to understanding the crypto market, you're in the right place. So subscribe and like the video, and follow us on Twitter at Upside Down Data. We put out regular updates there about our UDPI risk indicators and more. So first of all, what are what is technical analysis and what are fundamentals? Technicals is mainly what we focus on this channel. We analyze price action. We look at various quantitative indicators that tell us where the price is relative to those indicators and where the price is going. So technical analysis is all about analyzing price action. Fundamentals, on the other hand, refer to the intrinsic value of the asset, how good the technology is, the importance of the use case, the skill and the dedication of the team running the project, the revenue and the earnings potential of the project, all of those kinds of things that get at the intrinsic fundamental value as opposed to the technical price action that's happening. And so these are two different tools that are commonly used to analyze assets, not only in the crypto space, but certainly they feature prominently in the crypto space. And I'm going to be explaining to you when to use each, how to use them most effectively by using them at the right times and not using them at the wrong times. Basically, what it comes down to is this: fundamentals matter a lot when the market is bearish, but using fundamentals can even hurt your investment performance when the market is bullish. But on the other hand, technicals are mainly useful when the market is bullish, and they are less useful when the market is bearish. That's basically what it comes down to. And what I'm basing these claims on is this paper. This is a scientific paper, a peer-reviewed journal article from the Journal of Financial and Quantitative Analysis. This is a reputable and pretty influential journal in the field of behavioral finance. It has an impact factor of 2.70. If that means anything to you, it's not bad. It's not the New England Journal of Medicine, but it's not bad. This is a journal that has some influence and is quite reputable. And this is a research study that was published in that journal that basically shows what I just summarized. You can pause here and read this abstract if you're interested. And the paper itself has lots of really good stuff if you want to dig in. But I'm just going to summarize for you really briefly what the argument is here for why fundamentals matter more in bear markets than bull markets, and why technicals matter more in bull markets than bear markets. Here's the technical side of things. Basically, the article argues that technical analysis works better, that analysis of price action works better when there is more mispricing. Mispricing basically means irrational investor behavior. It means optimistic or pessimistic behavior that causes bubbles, inflates the price beyond where it should go in one direction or another. And when that's happening, when this sentiment-driven mispricing is running rampant, technical analysis is really useful. But here's the key: there's more mispricing to the upside than there is to the downside. So that kind of thing happens, these bubbles where the price gets away from the fundamental value, happens more when the price goes up than it does when the price goes down. Why is there more mispricing up than down? This is a pretty interesting thing to know about the market, I think. And this is one of the important implications of it. The reason that there's more mispricing up than down is because optimistic market participants can drive up the price by buying when they're bullish, but they can't as easily drive down the price by selling when they're bearish. And the reason for that is because there are limits on short selling. Basically, it's easier to long than it is to short, because to long, you can just buy the asset. To short, you have to have the asset first, which means that you either have to have bought it earlier and then you're selling your position, or you have to borrow it and then sell that with the plan of buying it back later at a lower price. This is just a more difficult thing to do. It's more time consuming, it's less easily automated, and it's less easily executed, especially by unsophisticated or relatively unsophisticated market participants. And that limits mispricing to the downside. And so when things are bearish and prices are going down, prices are more likely to stay relatively close to fundamental value. So TA is more useful when prices are going up. No surprise here, fundamentals are misleading when mispricing is high. And that's because mispricing is defined as the price going out, beyond what the fundamental intrinsic value says that they should be. And so if you're basing your estimates, for what's a good buy or what's not on fundamentals, when things are really bullish, you're going to be confused by that. This is what happened to this SHIB person, right? This is what happened here, where this person couldn't comprehend why his portfolio, which was full of fundamentally sound assets, was being outperformed by Shiba Inu, which is not, as fundamentally sound a project as many others in its market cap league or across the market as a whole. But as I mentioned, in bearish times, prices track fundamental value more closely. So that's the time that you want to use fundamentals. Fundamentals in a bull market can be misleading because they would cause you to ignore mispricing. Mispricing of Shiba Inu made it go to the moon. That confused people who didn't understand mispricing. But now you understand mispricing, so you won't be confused by seeing assets without fundamental value pump in a bull market. Basically, just summarize it all for you. In bull markets, don't worry too much about fundamentals. Focus on technicals. That's what's really going to drive price action. That's what's going to determine the best performers. Mispricing and understanding sentiment. What are people optimistic about? What are people excited about? If people are excited about SHIB or a meme coin, then when broader market conditions are bullish, that meme coin can perform really, really well. And don't be surprised by that, regardless of fundamentals. But in bear markets, fundamentals are everything. So don't ignore fundamentals. Use them strategically, and don't ignore technicals. Use them strategically by understanding what the market conditions are and then prioritizing accordingly. So let's make this more concrete to finish up. Where are we right now in the market? And should we be focusing on TA or FA, technical analysis or fundamental analysis? Well, price action has definitely been bearish recently. Bitcoin has fallen below the 20-week moving average, which has historically been an important level to hold during bull markets for continuation. On the other hand, it's not too far under the 20-week, and it could theoretically recover it quickly. It is still holding the 50-week, which is also an important level historically. What we're looking at here is the risk gauges. These are our UDPI risk gauges for the 22 assets that we cover. And so this tells us a bit about, the technicals. How overheated versus underheated are these assets and the market as a whole? And what I think about right now is that we're kind of in an in-between time. And it makes sense to keep our eyes on both as a result. And so on the fundamental side, in my opinion, this is definitely not the time to be aping into meme coins. But on the fundamental side, it does seem like an excellent time to accumulate some fundamentally strong projects that you can have a high degree of confidence will recover with the market as a whole whenever the market as a whole recovers. But I think you can also use technical signals to improve that decision. So if you're going to focus on fundamental assets, you can still prioritize fundamental assets that are also technically strong. And so, for example, I'm more interested now in low risk assets like DOT, like Phantom, like HBAR, like VeChain, rather than relatively higher risk assets that are also fundamentally strong, like Avalanche and even Ethereum. So those are all fundamentally strong projects that I just listed, but they do differ quite a bit in terms of their technical profiles right now. So that's how I would think about this. We are in, we're still in a broader bull market that has not been invalidated, but we're in a relatively bearish phase of that. And so I think that's the time to be using both fundamentals and technicals in our analyses. So hope you guys find this useful. Remember, with the UDPI, WAGMI.